We're here today with Stephen Inglis, who is Chief Executive of London and Scottish Property Investment Management, which is the asset manager for Regional REIT. And Stephen is also a non-executive director on the board of Regional REIT. Stephen, could we start by you giving a brief overview of the recent 2022 results?
Sure, of course, Martin, and nice to see you again. 2022 on operational level, the REITs performed very well. So against a difficult backdrop given last year, both politically in the UK and of course the consequences of higher interest rates and inflation. But let's just talk about earnings. So we suggested at the beginning of 2022 that our earnings would be 6.6 pence per share, and we would pay that in dividend. And indeed, that's exactly what we've delivered. So the highest dividend in the sector, and pleased that we've been able to, again, for the 7th consecutive year, produce one of the highest dividends in the entire real estate market. So 6.6 pence per share, and of course, fully covered, Martin, by earnings. Many obviously have not been fully covered for the last couple of years. We continue to be, and I think in the backdrop, as mentioned, a very, very strong performance. Now, why do we produce such good results against those headwinds? Well, it was a great letting year. You know, despite all of the forecasts of doom and gloom and no return to the office, we undertook 114 new lettings last year, by far and away a record, producing £5.9 million of additional income. And that on top of our renewals, which ran at just over 70%. We historically, as you know, have produced renewals between 70 and 75% consistently since we've been on market. So with those renewals and that income, then the headline rental number looks very good. Now, again, you're looking at that from a point of view of 6.6 pence per share. Well, why were we not ahead of that level? Well, purely and simply, we've had increased costs. You know, we have had a high level of inflation, and of course that has an impact on all supplies and providers to our buildings. Much of that, of course, we can pass on to tenants, but we have post-pandemic been running at a lower occupancy rate than we had to pre-pandemic. And whilst I'm pleased to say that that occupancy rate continues to rise, and again, we reported an increase at the year end up to 83.4% EPRA occupancy, it's still some way off where we were pre-pandemic at 89%. So we've got some way to go. And of course, those vacant buildings incur vacant costs. And therefore, that has been the negative, if you like, in terms of our earnings, but nonetheless, a very strong earnings year. I think we then look at the negative. The big negative, of course, is valuation. And I know we'll talk a little bit more on that in a second. But clearly, there is a disconnect between the occupational markets, which are performing at a reasonable level, thus the leasing and renewal story, and the investment market, or I'd be more specific and say the theoretical valuation market.
And well, you're alluding to valuation. It was obviously a very weak second half across the whole UK commercial property sector. Can you talk a little bit more about your performance and, more importantly, what your expectations are?
Yeah, I mean, it's a very, very highly unusual situation. So what we clearly had post the dramatic short-term trust situation was a massive increase in interest rates. Now, nobody would suggest that increases in interest rates does not impact value. Of course it does, but there is never a direct correlation. So what normally happens, and I've been in business for 35 years, so I've seen increases in interest rates and indeed falls in interest rates. What normally happens is interest rates rise or fall. The investment market then takes some time to digest that and decide what, if any, impact that has on what they're prepared to pay for assets, and that then flows through to the market, and that determines pricing. What happened this time, Martin, was the valuers in their wisdom decided to decrease values with no evidence. So that normal period where the market would have sat back and really reconsidered its investment parameters didn't happen, didn't get a chance to happen as valuers hit valuations very rapidly. Now, valuers can never win, because after the global financial crisis, they were criticised very heavily for not decreasing values quickly enough. And I would say they've overreacted in this instance. So for our own portfolio, the market generally, our own portfolio, market generally, largest fall in any single quarter ever. And indeed largest monthly fall in the UK market ever. So all of the losses were Q4. In actual fact, if you looked at our own results, we saw a small increase in values in June. Now, in June, everybody expected an interest rate movement before the end of the year, an increase in interest rates, that is. Nobody anticipated the trust scenario and the fiasco that followed, and therefore nobody anticipated such a large increase in interest rates in such a short period of time. So we saw a 12.3% fall in the last 6 months. That's actually a 14.7% fall. So obviously a small increase at the half year deflected that slightly. So in effect, a 15% write down in our valuations. And the true answer is, until very recently, I didn't know if that was correct or not, for the simple reason there was no market evidence to support it or indeed deny it. However, there have been a number of transactions over Q1 and the beginning of Q2 this year that would suggest perhaps valuers have overreacted, and that valuation level is probably a low point. And that gives some comfort to me, and should give some comfort to shareholders. In terms of what I believe will happen, well, there's still not a huge numbers of office transactions in the market. There have been a few, and those few have been at reasonable levels, slightly ahead of the December valuation figures. But I would anticipate that the valuation market will be relatively flat at the 6 months period for us, and perhaps improving towards the end of this year. So, perhaps a slight improvement in December, 31st December being our full year valuation figure. But it's, I think the valuation market is extremely difficult, but we should be reliant on real life transactions rather than valuers' opinions of what may or may not happen. And I think that technically is wrong. Well, I think we've ended up in a place where everybody is relatively comfortable that values are bottomed. Now, for us, obviously, that has an impact. As with every other property company, we have a decent level of debt in our portfolio. And of course, that valuation decrease has impacted us in LTV. So with an aim of getting LTV to 40%, and indeed with plans to do exactly that in the short term, that's been blown out of the water for the short term. We're now sitting at 49.5%, which in real estate terms is still not seen as high leverage. But certainly in the investment trust world, we recognise that is not what the vast majority of investors want to see. And we're committed to getting that back to 40%. But we'll do that in a calculated way, whereby we're still maximising income returns, and we'll manage that LTV down over the next few periods.
Stephen, your portfolio is very diversified by tenant, by property, by region. But of course, you are moving towards almost entirely being an office play. Could you talk more about how you see the office market panning out?
Sure. I mean, much talked about subject, obviously. The doomsayer suggesting that the office is doomed and nobody will ever return, or if they do, it'll be for a couple of days a week, and therefore demand for offices will plummet. All very, very much a myth. And let me explain that in terms of statistics. So if we look at our portfolio, and London, I would add, is a very, very different market to the rest of the UK, and therefore have to be looked at differently. But look at our portfolio. We have over 150 assets, over 1,050 tenants, and therefore I think we're a decent barometer of what is happening out there in the UK regions. As at March last year, only 30% of the companies that occupy our office buildings were actually in occupation in any form. So, and that could easily have been one person in the office. We did that survey again at the end of November, and it was up to 99%. So all bar 12 of our tenants were back in the office in some form. Now, the second part of that clearly is, well, that's great, Stephen, but if it is only one person in an office of 100, it doesn't really tell us a great deal. So we followed that up with a second survey, and that is ongoing, and I will report the full numbers in due course. But we're done about 75% of our portfolio, which covers about 25,000 people. So it's a very reasonable sample size. And the questions we want to know is, how many of your employees are back and for how long? Now, the pre-pandemic level is well stated as being 70. So 70% would be the number or the percentage of people in your office at a moment in time pre-pandemic, which allows for holidays, illness, and people traveling. And I'm very, very pleased to say that as of yesterday, literally yesterday, 85% of the pre-pandemic level has been achieved. And that's going up literally week by week. So we're now into the 60s against that 70% total. And that's, as I say, 85% of pre-pandemic levels. Savills themselves did a report a few weeks ago on a pan-European basis, and the numbers were very, very similar. They had 70% as their figure. They were at 55% at that point, i.e., 70% of pre-pandemic levels. So that's definitely encouraging. Now, the second part of that is, well, are they only in 1 day a week, in which, again, doesn't tell us a great deal. But again, I'm pleased to say that the average, which I expected to be 3 or somewhere around 3, but the average is actually 4 days a week. And that's, again, very, very encouraging from our point of view as a landlord, because that means our tenants are in the vast majority of time. So that in itself is very strong evidence that we're seeing a return to the office. Obviously, our letting story, which I mentioned earlier, record number of lettings last year for a record amount of space, again, is very encouraging to us as a landlord. And whilst we are not seeing record numbers of inquiries, we are seeing steady inquiries and inquiries that ultimately take space. So where the conversion rate is much, much higher than it was pre-pandemic. My colleagues unkindly say there are very few tire kickers around in terms of people looking at offices, but really no intention of relocating or taking them. That's just not happening. So the conversion rate's much higher. And therefore, I would say that the state of the regional office market is actually in a pretty good place. Now, we still have high vacancy rates, and alarmism saying there's 100 million square feet of space available in the UK. That is true. It's actually 101 million square feet, according to CoStar's latest data. 35% of that is in London, and a further 15% in 3 centres, one of which I'm embarrassed to say is Glasgow, where I am based today. So, very concentrated amounts of vacant space in a few locations. Overall, vacancy levels are low, and vacancy levels for prime and secondary following similar patterns. Again, I hear people in the street telling me, prime is full and secondary is empty. That's just not the case. We're not seeing that at all. What I would say is super prime space, uber prime space, whatever you want to call it, the best of the best, is undoubtedly the most popular, and it's seeing very strong rental growth. However, it's full. There's not much of it at all. And if I compare markets a little bit, and this is why I'm saying London and the regions are very different. London is 50% prime, 50% secondary. Even in London, the super prime only accounts for 1 to 2% of the market. The regions are very different. They're only 16% prime. The rest is good secondary, which is obviously a space that the regional REIT invest in. The super prime is absolutely full. The prime is pretty much full. Therefore, where do tenants go? Well, the next best, which is very, very good quality, grade A accommodation, not regarded as prime, but still grade A. And that's what we are providing. And therefore, I anticipate in the short to medium term, we will see the next stretch of rental growth. So the rental growth has been fantastic over super prime space, hasn't really moved much in terms of ours, although we are 7.3% ahead of past the previous passing rent. So we are seeing some rental growth. I anticipate that rental growth will speed up as we see the companies forced to take the next best space. Still very, very good space, meets all of their criteria, but it's just not super prime. The other argument over super prime versus secondary is ESG, and that companies only take the very best for ESG reasons. That's not true. There's been a number of studies done speaking with the occupiers of that super prime space saying, why did you take it? ESG is mentioned, but the main reason is for the retention and attraction of high quality staff. And actually, as labour markets begin to soften slightly, that the rationale for taking the very best space to get those staff begins to weaken slightly. And there's been a few studies done in America on this very subject, and it's definitely the case that as labour markets soften, the demand for that super prime space also softens.
But how much work will you have to do on the portfolio to keep pace with these trends in occupier demand, but also obviously energy efficiency requirements?
Yeah, I mean, EPC obviously is a big subject. The government have white paper, will be introduced as legislation shortly, which will mean that all landlords will require to meet grade B in terms of EPC rating B by 2030. We're well on the road to achieving that, and we'll achieve that in our normal CapEx expenditure well before 2030. And of course, that CapEx expenditure is already baked into the valuation. And that's perhaps an interesting one that people don't understand. Previously, valuations were done on an all-risk basis, i.e. there was no specific calculation of CapEx required in the portfolio. That changed about a year or so ago. So within our valuation, there's £58 million of CapEx that's been deducted already. So i.e. our valuation is net, that money's baked in, and that money's for CapEx projects to enhance the assets and achieve that EPCB rating. So that's already factored in. We spend somewhere between 10 and 15 million pounds a year in CapEx. Clearly, if you follow that through to 2030, we'll have spent far more than that 58 million pounds across our portfolio. So again, that should give investors a great deal of comfort.
Good. And you started by saying that you provide one of the highest yield in the sector with a fully covered dividend. It's obviously very early in the year, but from what you're seeing so far, how confident can you be about maintaining that position, maintaining that dividend?
Yeah, I mentioned earlier headwinds of costs, and undoubtedly we still have high inflation, which in many ways I think some people use as an excuse to increase costs, but nonetheless, there are increased costs to our buildings. So the key for us is reducing that void, getting more occupancy. The leasing market seems to be maintaining in the first quarter, certainly. We've got a whole host of leases where we're under offer to lease more space to tenants. And therefore, I would hope to improve the vacancy rate, or the occupational rate, I should say, reduce the vacancy rate. And that will have a good impact on top line. I think costs will continue to increase, and therefore, maintaining the bottom line is really where I think we're going to be. So, I think you can take from that, you were 6.6 pence per share earnings and dividend last year. I would expect a similar level over the course of 2023, assuming that all things stay the same. And of course, that's a big assumption in the current world. Something seems to come around the corner that we didn't anticipate every few months, but assuming steady state, then I would hope to maintain our net income.
And Stephen, you've recently announced that you're going to be selling a controlling stake in your company, the asset management company, to a large Singaporean operation. Can you talk a little bit about that and what effect that might have on Regional REIT?
Sure. I mean, that deal has now just completed, so you're absolutely right. We are indeed selling, or have sold, a controlling stake to ARA, who are a very large Singaporean fund, as you say. They in turn are part of ESR Group, and ESR are the third largest listed property investment manager in the world. They have $150 billion under management, Hong Kong listed, main investors, owners, and the main institutions you would expect. And the attraction to us was twofold. They already manage 11 other REITs across the world and have an expertise in the listed sector. And therefore, we can hopefully utilize that expertise to assist in the regional REIT story. From their point of view, they are very attracted to capital markets and indeed REITs, which they can, as I say, control 11 others. So they very much see regional REIT as a good opportunity for them to enter the UK listed sector and indeed help us grow the REITs and achieve greater shareholder returns. So I think it's a very, very good position for everybody. We'll be able to capitalize on their expertise across public markets and of course ESG, and they'll be able to capitalize on our local expertise in running regional REITs and hopefully achieving much greater shareholder returns as we move forward.
Well, thank you very much, Stephen. We look forward to following developments through the year.